All right, let's dive into a really big question today. How do you, a regular person, build some real, actually life-changing wealth starting with just a little bit of money? We are going to break down, step by step, how you can turn $100 a week into a $2,000 a month income stream. And I know that sounds like a crazy big jump, but the path to get there is probably a lot more straightforward than you think.
Seriously, just for a second. Picture that. It's a Tuesday, you wake up, no crazy alarm, no frantic rush to get out the door, just this quiet feeling of calm, knowing that your money was working for you while you were sleeping. This isn't some lottery dream. This is a real thing you can build with a simple, repeatable plan.
So, the big question is, how? How do we make that happen? Well, to make this all feel real and not just a bunch of numbers, we're going to follow the story of a regular guy. We'll call him John. We'll see exactly how he can build this exact future for himself.
Okay, let's meet John. His story is basically our roadmap for today, because, well, he's probably a lot like you and a lot like me. He's not some Wall Street genius or a tech founder who got lucky. He's just a normal person who wants to build a more secure future, one small step at a time.
So here's John's situation. It's pretty simple. He's 38, he's got a steady job, and he's found an extra $100 a week. You know, money that might have just disappeared on extra coffees or a subscription he forgot about. His goal is super clear. He wants an extra $2,000 a month coming in by the time he hits 65. That gives him a 27-year runway. And believe me, that is his secret weapon.
So what's the magic trick that makes this whole thing possible? It's a concept that's so powerful, Albert Einstein supposedly called it the eighth wonder of the world. I like to think of it as the snowball superpower. You probably know it by its official name, compound growth.
You know, in the simplest terms, compounding is just your money making its own money. The returns you earn get plopped right back into the pot, and then that new, slightly bigger pot starts earning its own returns. It's this amazing cycle that starts off really slow, but over time, wow, it builds some serious momentum.
The best way to picture it is like a snowball at the top of a huge, snowy hill. Your first $100 is just a tiny little handful of snow. But as you start rolling it down the hill, by adding more money and letting the returns stick, it starts picking up more snow. Before you know it, the snowball gets so big that its own weight is what's making it grow faster and faster. John's 27 years? That's not a waiting game. That's a really, really long hill, giving his snowball an incredible amount of room to grow.
Okay, so let's get practical. Let's look at the first strategy John could use. We're going to call this one the growth engine. The name says it all. The goal here is simple. Make that snowball as big as we possibly can over the next 27 years.
So John's plan is super simple. He takes his $100 a week, every single week, and he puts it into an ETF with the ticker symbol VOO. All this fund does is buy a tiny little piece of the 500 biggest and most important companies in America. See, he's not trying to pick the next big stock. He's just betting on the American economy as a whole, that massive engine that's been creating wealth for over a century.
And this is where you see that snowball effect really kick in. Look at these numbers. After 10 years, he's got a solid $87,000. Pretty good, right? But look at the next 10 years. He adds over $200,000. And then in just the final 7 years, he packs on another $260,000. That's the snowball really picking up speed. And just like that, after 27 years of just consistently, boringly putting in $100 a week, John is projected to have a portfolio worth over $500,000. I mean, just let that sink in. From $100 a week.
And this chart right here, this is the real magic. Of that 560 grand, John only put in about $140,000 of his own money. The other, almost $420,000, is just pure growth from the market. That's the reward he gets just for being patient and consistent. It's pretty amazing.
All right, on to path number 2. This one builds a totally different kind of freedom. This strategy isn't really about getting the biggest possible pile of money at the end. No, this is about creating a steady, reliable stream of cash that pays you kind of like a salary, but without you ever having to sell anything. So for this path, John puts his $100 a week into a different ETF. This one's called SCHD. This fund is all about owning high-quality, stable companies that are famous for one thing, sharing their profits directly with people who own their stock. We call those payments dividends. It's literally like owning a whole bunch of tiny businesses that just send you a check in the mail every few months. Now you'll see the final portfolio value is a little bit lower than Path 1, clocking in around $510,000. But, and this is a big but, that number isn't really the point here.
The real story is the income that this pile of money starts to generate all by itself.
See, the real power of this strategy is that these kinds of companies tend to increase their dividend payments almost every single year. So that income stream you're getting, it grows. It compounds on its own. And over time, that growing paycheck eventually hits John's $2,000 a month goal, and he gets that money without ever having to touch his original investment.
But what if John's a little nervous? What if the idea of the stock market bouncing up and down all the time stresses him out? Well, that brings us to our third and final path. We'll call it the Sleep Well plan. This one's for the investor who really just wants a smoother ride.
With this plan, John just splits his weekly $100. Part of it goes into a total stock market fund for growth, and the rest of it goes into a bond fund for stability. You can think of bonds as like a shock absorber for your portfolio. When stocks go down, bonds often hold steady or even go up, which really cushions the blows and makes the whole journey feel a lot less bumpy.
And yeah, as you'd expect, the numbers here are a little lower. The final portfolio ends up around $370,000. Now, that's less than the other two paths, for sure, but the trade-off is that the journey to get there would have been way less stressful. Fewer sleepless nights, you know?
Now, this portfolio would generate about $1,233 a month on its own. And you might be thinking, hey, wait a minute, that's not $2,000. But here's the secret to this path. This portfolio doesn't have to do all the heavy lifting by itself. When you add in the average Social Security payment, John's total monthly income is well over $3,000 a month, which totally crushes his original goal.
So, there you have it. 3 completely different ways to get to financial freedom. And the right choice, it's not about which one ends with the biggest number. It's about which path best fits who you are, what you're trying to do, and frankly, what's going to let you sleep well at night.
So take a second and just ask yourself, which of these sounds the most like you? Are you the person who just wants to grow that snowball as big as possible? Or do you love the idea of building an automatic paycheck for yourself? Or are you someone who just values a calm, steady, stable journey above everything else?
And this little table just lays it all out. The VOO path gives you the biggest pile of money at the end. The SCHD path builds you a little income machine that runs itself. And the bond blend gives you the smoothest, safest ride that works as part of a team to get you across the finish line. There's really no single best answer here. There's only the answer that's best for you.
So what this all proves is that these small, consistent actions, when you combine them with the incredible power of compounding and a long-term plan, they can lead to absolutely amazing results. That $100 a week isn't just $100. It's a building block. It's a seed you're planting for your future freedom. So the only question left to ask yourself is, what kind of future are you going to ask it to build?